with the February contract, which completely is gone in a couple of days, right? Like 3 days. As of yesterday, for February gold contract, right? There were still 4,366 contracts open. That's 436,600 ounces, or 13.5 tons of gold. Now, what's unusual about that, in fact, insanely unusual, is that it's insanely high, that number for this late in the cycle. In fact, it's 24 times normal. It's even bigger than the upcoming March contract, which I don't know if that's ever happened. That's a massive red flag. And really what it means, what most people would tell you it means, is a classic fingerprint of a big short that sold gold that they may not actually have to pay back. And if they were planning to buy it back, one would assume that they're somewhat trapped because liquidity is this late in the February contract is very thin. You know, everything that the West has done for a long time is all about confidence. And for a long time, no one questioned the integrity or motivation of the West or of the United States. But that might be changing. And the moment the market believes that there isn't enough gold, the leverage that has really been the hallmark of this industry or of this platform unwinds. And when the leverage unwinds and commodities moves become really violent. So we've seen in February 4,639 contracts delivered. That equals, what does that equal? 23,195,000 ounces of, this is silver, by the way, excuse me, 23,195,000 ounces of silver. So 4,639 contracts times 5,000 ounces is 23,195,000 ounces. Okay, so that's about the low end of what we've seen since a year ago, November, every single month. Every single month it's been between typically 30 and 70 million ounces that stand for delivery. So that's a big deal, right? But here's a bigger deal. So while we have seen 23,195,000 ounces stand for delivery, in the month of February, we have seen 38,082,934 ounces leave COMEX. Leave. Now, if I keep saying this to put it in perspective, if a mint box of Silver Eagles weighs 42 pounds for 500 ounces, who took possession of 38,082,934 ounces? How many semi-trucks is that? And where is it going?
Right now, the global financial system is under pressure. Governments are running historic deficits. Central banks are quietly accumulating gold. Trade tensions are reshaping supply chains. And investors are increasingly questioning long-term currency stability. But while headlines focus on stocks and interest rates, something much more important is happening beneath the surface. In the gold and silver markets, physical metal is moving. Deliveries are staying elevated. Registered silver inventories remain tight relative to paper claims. And the divergence between financial contracts and tangible supply is becoming harder to ignore. Andy Schectman's message to investors isn't about chasing price spikes, it's about recognizing structural shifts before they become obvious. Because when confidence in paper assets weakens, capital doesn't disappear, it migrates. And right now, it's migrating into hard assets. Let's examine why that matters.
And so I would say to you, the people that are doing this understand where the puck is going. The people that are spending this kind of money and withdrawing it out of the ecosystem, where the vault withdrawals are 164% of the February delivery demand so far, that means more metal is being pulled out than delivery alone can explain. This is highly unusual, highly. Let's talk about the March contract. Now, I haven't updated it over the last 2 days, but a couple of days ago, there was still 47,847 contracts in silver outstanding, with 4 days left till it comes off the board. That's 239.2 million ounces of silver. In contrast, the total registered silver inventory, that is the category of metal specifically earmarked for physical delivery, stands at 88 million ounces. What this is a paper Ponzi scheme, and it's a looming game of musical chairs. If even half of that open interest actually decided to stand for delivery. That's 120 million ounces with only 88 million ounces in registered. Do you see how that becomes a massive, massive problem? And so, I think that this is how stress shows up. It's not in price, but in the delivery mechanics. And when the paper claims tower over the deliverable pile, the market only stays calm until it doesn't. The continued arbitrage that we see in Shanghai, where the silver price has been between $10 and $20 an ounce more than in the West, enticing arbitrage. Normally, an opportunity like that doesn't last very long as the sophisticated traders capitalize on that arbitrage. But when you realize that it is staying strong, that tells you that the Chinese are saying, look, we're choking on dollars. The dollars are not worth as much as the silver. Keep the arbitrage, keep that higher premium so that you get the traders who will buy 20 million ounces in the West and deliver it in China. Typically, there's a COMEX contract that goes right to Hong Kong where a Brinks truck would pick it up or a truck would pick it up and bring it to Shanghai. At a $20 or $15 or $20 an ounce premium on 20 million ounces, you're making enough to change your life 10 times over. And are they doing it? Sure. And it's not even that premium that they're paying, the Chinese are paying to buy that. On top of that premium, there's a VAT tax. That VAT tax is not the responsibility of the exporter into China. It is the responsibility of the recipient when it leaves the Shanghai Metals Exchange. They will be charged a VAT tax. So they're willing to pay a 13, 14, 15% VAT tax and a $13 or $14, $15 premium on top of that to entice the Western traders to send it. That tells you where the real value of silver is, and the movements and the mechanics and everything we've seen so far in terms of price to the downside in many respects is contrived through raising margin requirements, through trying to squeeze the speculators out. And you can see that by the open interest, which is falling considerably. It worked. It did. And that metal then has moved into the strong hands who don't use margin, who I would venture to say over the next several days plan on standing for delivery in huge amounts. And now that Shanghai is open today and you see the price down a little bit, it's interesting as we get right to the end of the delivery cycle. This is what they're going to do again, where we saw before the price got hammered. Not only did JP Morgan cover almost 800 contracts at the very, very, very bottom. Interesting how they did that. But how about SLV? During Silver Squeeze, SLV said BlackRock amended the prospectus, I think, on a Saturday night. And they said there's such inflow coming and there could be a lag between the time that we indeed confirm this as a good trade and when the shares are issued, because it's coming so fast and there could be a discrepancy there. Shares are issued when the metal is deposited into the exchange. So right before the market collapses, it's at $115, $120 an ounce, record volume into SLV. It collapses, and right at the bottom, guess what? 38 million ounces of silver are deposited into SLV by an authorized participant at the bottom where the shares are created. Does it seem interesting that they sell it up here, they deposit it down here, and then the metal moves from the COMEX into the SLV vaults that are institutionally controlled by those commercial banks that issue the shares, and they continually do what's called share redemption and stand for delivery on metal inside the SLV ecosystem and GLD with great privacy. It's far more difficult to tell who did that than it is to look at the COMEX COT reports or the delivery reports. So lots of stuff going on, but again, the movement of metal is, to your point, really all that needs to be seen, whether it be deliveries on COMEX, deliveries out of the COMEX ecosystem, or standing for delivery across the globe. And I don't trust the ecosystem is what that says to me. Or it's either that or it's the Exchange Stabilization Fund taking it on behalf of the U.S. Treasury, because it is now, it's just a coincidence that for 16 months we've seen massive inflows and then it gets reclassified critical and a state-sponsored price floor and a state-accumulated strategic stockpile. But the point of it is that a lot of it's leaving. So if it isn't something like that, or Tesla or Samsung or Sony, and bringing it to their production facility, then what the hell is it? The question is, who's standing for delivery to these numbers? That's all that matters. And that's the part that is strangely, and I think kind of conspicuously, if you will, omitted, because to me, that's all that matters. When you have an environment where information is worth probably more than anything, these people are informed. You don't spend 9 figures a month for a year and a half almost, or a year and a third every month by taking delivery, which is ridiculously unusual outlier. I mean, the majority of the contracts that posted in February have stood for delivery. That's unusual as all can be. Normally, it's 1% or less. So who is standing for delivery at these levels? That's the only question that should be asked. And the answer and the silence of its reporting, to me, speaks volumes. This is connecting the dots and realizing that the people who have pulled these strings are powerful enough to pull the strings in violation of antitrust law, powerful enough to have Bart Chilton, the former head of the CFTC, to be told to back down, Bart, it's a political decision, powerful enough to let JP Morgan continue to run the world's largest silver trust after paying a $920 million fine for manipulating the market, and the second or third largest stockpile of gold in the world. Well, maybe not that large, fourth or fifth if you had central banks, but a massive stockpile. They are the primary custodians with BlackRock of SLV and GLD, and yet they paid this insane fine.
Here's what matters. COMEX silver registered inventory, the category actually available for delivery, has recently remained near the sub 90 million ounce level. Meanwhile, open interest in active contracts has represented multiples of that amount. That imbalance doesn't automatically mean default, but it does mean leverage is high. At the same time, delivery demand over the past year has consistently run strong compared to historical norms. That's not a retail phenomenon. Large players are choosing to stand for delivery instead of simply rolling contracts forward. Andy Schectman emphasizes that this is where the real signal lies, not in price volatility, but in behavior. Now layer in the geopolitical backdrop. Global central banks have been net buyers of gold for multiple consecutive years. Countries across the global south are increasing bullion reserves while gradually diversifying away from dollar exposure. Ongoing trade tensions, elevated sovereign debt levels in the US, and persistent inflation concerns continue to create a macro environment where tangible assets regain strategic importance. Silver adds another dimension. It is both a monetary metal and a critical industrial input, used heavily in solar, defense electronics, EV systems, and advanced manufacturing. Global mine supply has struggled to keep pace with demand in recent years, with structural deficits reported across multiple cycles, and only a small percentage of annual silver production comes from primary silver mines, meaning supply response is slow even if price rises. So when you combine tight registered inventories, persistent delivery activity, multi-year supply deficits, strong central bank gold accumulation, geopolitical fragmentation, and de-dollarization trends, industrial demand linked to energy transition, you start to see why Andy argues this isn't a normal cycle. His core view is this: price is used to shake confidence, while informed capital accumulates quietly. When leverage eventually unwinds, price discovery can become aggressive. He isn't predicting dates, he's highlighting structure, and structure is what moves markets over time.
So they're powerful enough to do all this. I'm sure they're powerful enough to ask the media to please let this one go and don't bring it up, because it is on behalf of the United States government. It's about national security. So, I mean, again, there is a fine line between conspiracy, reality, and how things are going down. But I ask myself, is this really, is journalism and what it stood for gone and dead? Or are they just blind to what is the most obvious thing that I've seen maybe in my career, and that is the most well-informed money, starting with the central banks in 2017 and now not stopping, and now moving also into the big traders here doing it. That's all that matters. To me, that's all that matters, because it tells you that price is just being used to misdirect you or to shake you off the back of the bull. And the rest of it to me is moot. It's easy to rest calmly in the face of massive drawdowns when you see the deliveries by these people. That's never, when those entities were doing it, not a word about what was happening here. But now you see it here. And that's what's so vastly different. And so too is, of course, the way that this administration has classified platinum and silver critical minerals. And of course, the Judy Shelton talking about what she believes gold's role will be in the future for the U.S. Treasury. Of course, gold and its expanding role in the global South as a settlement vehicle. These things are happening. Media doesn't talk about it at all. So that should tell you, this is why and how big money repositions. They reposition under the cover of media silence and of rhetoric that is contrary to what they're doing and of price. And when you have the ability with tremendous leverage to move the price, it's easy to do to create that narrative. And again, when you see the price get hammered and then you see JP Morgan cover and metal put into SLV and the deliveries continue at a massive clip, that should tell you all you need to know about really what the motivation is. When we're getting to the point where countries, just like they don't want to hold dollar treasuries because they don't trust them anymore, many of them, they won't want to have metal held within the COMEX or the LBMA. They don't trust it. And maybe that's why you're seeing metal move at such a clip. And one of the things that people have such a hard time with is, your mind says, well, why not just buy it all, right? Why doesn't a wealthy guy like Bill Gates just buy it all? It doesn't work that way. If the Chinese or a wealthy guy says, I'm going to buy it all, good luck getting it all, because the minute that happens, not only do you blow things up within the exchange, but the minute that gets out, everyone will beat you at it and stand for delivery themselves. So this is done by, you bleed out the victim by 10 million paper cuts rather than, one samurai sword to the whole thing. And I think that's the part people have a hard time understanding. They're dismissive of the well thought out strategy of those in the global South to do this methodically. And you can see it if you look closely. It's increasing exponentially from when we started talking about it 5 years ago. And they're doing it the right way, just slowly enough to keep it from being on the mainstream, but not slow enough to where we don't notice it. I see it very, very clearly. And again, I will say it for the 1 millionth time, the only thing that matters is that the most well-funded and well-informed traders on the planet, from the central banks to the commercial traders here in the United States, are telling you through their actions that gold and silver are worth far more than the paper dollars they're using to buy it. That's all I need to say. And I could drop the mic right there and shut this off and walk away. And I would feel if people really listened, they would understand where this is going. You would see massive institutional selling, not buying, if indeed this was something that wasn't as important as I'm trying to make it. Well, in a world where price has been suppressed forever to support the military-industrial complex and their ability to accumulate cheap silver to make high-tech weapons for years, price has it's never found price discovery. But what that has done in particular by keeping it so ridiculously undervalued based upon its value and utility, in contrast to its value and utility, its real value and its utility, it is disincentivized domestic mining. And so when you try and find a mine, not only, silver, of all the metal mined last year, only about 20% came from companies that exclusively mine silver, about 160 million ounces. But that's it. Out of the 850 million or so that was mined, it's the 6th year in a row of a systemic shortage. About 200 million plus ounces for 6 years in a row. A 1.2, 1.3 billion ounce shortfall over the last 5-6 years. And so when you talk about why would they do this, it's being done to incentivize mining here in the United States.
Here's the bottom line. We're living through a period of rising geopolitical tension, record sovereign debt, shifting trade alliances, and increasing central bank accumulation of gold. Silver sits right in the middle of that macro crossroads. Andy Schectman's direct message to investors is clear. Follow the physical flows, watch the inventory, pay attention to delivery. The smartest money in the world leaves footprints, and they're visible if you look. This isn't financial advice, it's strategic awareness. Now, I want to hear from you. Do you believe silver's structural tightness eventually forces a major repricing? Or does the system absorb it quietly? Drop your view in the comments. And if you want serious macro-driven breakdowns on gold, silver, geopolitics, and global capital flows, subscribe and turn on notifications. Because in markets like this, being early matters, and the signals are getting louder.